So what have banks learned from the collapse of Lehman Brothers, and are they equipped to withstand a sovereign default? Our next guest is certainly well equipped to answer such questions. Alan Kapper has been in the financial market for more than 20 years and is a former member of the credit strategy team at Lehman Brothers. These days, he's head of strategy at Lloyds Corporate Markets. Join me in the studio now. Thanks very much, Alan, for coming in. So, did the demise of Lehman expose risks within the banking system that, to some extent, have helped impact or shape processes when it comes to managing your investments?
I think we're in a totally different environment now. I think the main thing to focus upon right now is the key risks for banks and also for real money investors, insurance companies, is that we're in a sovereign debt crisis. And it's very difficult for the system to withstand a large sovereign default. Lehman was a different issue. That was related specifically to Lehman and to banks. And therefore, I think it's very difficult to draw comparisons between the circumstances we're in now and then.
But I suppose what came afterwards, a freeze in credit markets, risk assets going into free fall, exposed how interlinked the banks actually are. The sort of nervousness that it caused in the market sort of seemed to, I mean, at the time it felt as though the sky was falling, didn't it? I mean, it just sort of seemed to call the whole fabric of Western banks into question.
Well, I think you hit the nail on the head, as you said. It showed at the time how interlinked the banks were. Now we're showing at the time how interlinked the European sovereigns are and how interlinked the European sovereigns are with the banking system as a whole. That's why I think this is a sovereign debt crisis.
Yeah.
That's the kernel of the issue. And that's why I think most of the news flow that bothers us right now is actually surrounding the sovereigns.
Yeah, but I suppose when we speak about a sovereign debt crisis and about contagion, Greece defaulting is one thing. Then I suppose the big concern is that once that happens, how do you ring fence it? It spreads to Italy and Spain, and once it spreads to these bigger Eurozone countries, well, then essentially it does become a banking crisis.
We need to distinguish between Italy and Greece. The key issues about Greece are that it's relatively small, but it showed up just how weak the Eurozone policy-making process was, and therefore people started thinking about banks after that. And of course, how life is in the future for real money investors building a risk-free asset. Italy is more a problem by virtue of its size. It's much harder to bail out Italy. That'll put a lot more strains on the system. So I think in the context of Greece, while the market worries about a default, that's probably not the big issue there. The big issue is Italy and possibly Spain.
And then what would, if we did see contagion to those countries, what would that mean for the banks? We've already seen write-downs on sovereign debt holdings with regards to Greece, but do we now need to see something more broad-ranging in terms of the banks being recapitalized? There's been a great deal of talk about cash injections from the EFSF. I
think if we were to become very concerned about a default, I think firstly we would need to drill down and figure out what do we mean by default. Is this a restructuring with a relatively small haircut? Is this a repudiation of debt? I think the latter's very, very unlikely. So first question is going to be, what is the magnitude? When people talk default, we think something of enormous magnitude. Question one, what is the magnitude? Secondly, this affects all investors. Banks are just a subset of investors. Real money investors looking for risk-free assets are large holders of sovereign debt. For them, it'll be at least as critical as it will be for the banks.
Yeah. I mean, the crisis that we're having now, as you say, is very different. The problem is essentially sovereign debt. But banks traded on this, didn't they? On the premise that essentially they were risk-free and very liquid, as you have pointed out. So what is this going to mean for asset allocation going forward?
This is a real challenge, because I think once we go into 2012, investors and banks are part of that whole story, will be looking for new risk-free assets. The type of risk-free asset one could consider, and of course no asset is risk-free, that much is clear, portfolios of non-financials, heavily capitalized non-fin companies. A portfolio there could in many ways prove more robust over time than, for example, a portfolio of a small number of sovereigns. So I think you'll see different types of structures emerge in 2012, and that'll reshape the investment universe.
Really interesting to talk to you. Thanks very much indeed, Alan Kapper, Head of Strategy at Lloyds Corporate Markets. And